Hello. Thank you for joining me for the second quarter market review. My name is Lance Gunkel, and I'm the Managing Director at Severson Strege. The first half of the year was kind to investors, and I'll focus on three factors that provided a clean runway. First, let's look at return figures through June 20th. The stock market indexes representing both developed and emerging markets were up, with the U.S. leading the way, up about 14%. Bond prices in the U.S. and abroad have recovered, with both U.S. bonds and global bonds up 2%. Coming into the year, there were three issues getting in the way of the market, and all three are now a bit clearer. Issue number one, the debt ceiling standoff, was resolved, at least for a while. 2 days before the so-called X date, when Janet Yellen said the U.S. would run out of cash to pay its debts, President Biden passed the Fiscal Responsibility Act of 2023. The act suspends the federal government's borrowing limit until 2025, allowing the Treasury to resume selling debt. This takes the issue off the table for a couple of years and may be a tailwind for markets. As you can see on the chart, the S&P 500, a U.S. stock market index, reacted positively once the House passed its version of the bill. Issue number two, the Fed has finally hit the pause button. The federal funds rate, which influences borrowing costs on all kinds of loans, including car loans and mortgages, had been held at near zero during the pandemic. A low rate was maintained to encourage consumers to spend and companies to hire and expand in an effort to counteract the economic shock caused by COVID. The strategy worked and the market took off to new highs. Eventually, however, the surge in spending combined with supply chain problems led to inflation. The Fed is now trying to do the opposite, raise borrowing costs to discourage spending and allow supply and demand to rebalance, curbing the high inflation that took off in late 2021. The Fed funds rate is at 5.25%, its highest since 2007. Setting the right monetary policy is a delicate balancing act, though. Raising the Fed funds rate too high could slow the economic growth so much that the country slides into a recession with significant job losses. Historically, significant Fed rate hikes have led to recessions, but the economy has proved unusually resilient in the current cycle. On June 14th, the Federal Reserve held off on raising interest rates for the first time since its historic effort to curb inflation began 15 months ago, giving it more time to assess the impact of previous hikes on the economy. The Fed's decision to ends a streak of 10 consecutive increases. This leads us to issue number three, inflation. The temporary rate hike pause comes after the government's latest data showed inflation in May rose 4% year over year, a decrease from April's 4.9% and the 11th consecutive month of slowing inflation. The 4% rate is still the smallest in annual inflation growth since March of 2021, and it's much improved over the 9.1% figure from 1 year ago in June 2022. Still, Federal Reserve officials suggested rate increases could resume later this year with 2 more quarter percentage point moves as inflation remains above the central bank's 2% target. Policymakers also released updated economic projections, forecasting the economy to grow 1% this year, up from March's estimate of 0.4%. Inflation is expected to cool to 3.2% at the end of this year and to 2.5% at the end of 2024. While this review examines the past few months, I'll remind you that it's just a snapshot into what should be a long-term view of the investment landscape. At Severson Strege, we monitor economic events, but take a long-range perspective when we make decisions. Thank you for your continued trust, and we will see you soon either in our office or our next quarterly update video. Cheers.